at, the first thing we're going to look at is Yahoo Finance. It's one of the best places for commentary about the stock market and big news stories that affect the S&P and the rest of the stocks we're watching. The labor market, everyone was waiting for a labor report to come out. And it basically said that we've made back all the job losses from the pandemic as of this report. So it basically is double the amount of jobs expected. So that put a lot of pressure on the bond market, because whenever there's a strong economy, the treasuries go up, and that puts pressure on stocks and tech stocks. So it may sound funny, we're concentrating on this interest rate and oil, but it ends up being a big, it's very important variables in why stocks go up and down. Okay, so now we're going to look at the S&P 500 next. Okay, so let's look at, okay, this is a June 17th lows. You can see that we're actually making higher highs, higher lows now. We're in a different pattern right now for almost every stock we're watching. And it's important, whenever we're in a downturn, to monitor these channels of support for the stocks and indexes you're following. Right now, let's go back up to the top, to the S&P 500, and zoom in on this. Okay, so we were in this downward channel for a while, lower highs, lower lows, and we mentioned at this point in time that we were possibly breaking out of that channel into a higher high, higher low situation. We're basically still at the top of this newfound range, higher highs, higher lows, and we're going into two seasonally bad months of the year, and that basically almost predicts we're going to be going back to one of these lower channels of support next, because we're super overbought. Regarding overbought and oversold, the stock market basically goes into these phases of either people being too excited or too fearful. And right now we're in a situation where we're overbought, and we've been overbought since last Friday, and we kind of predicted this week would be there'd be some selling pressures, because we don't stay in this elevated support usually for a long time. So we're still overbought in the stochastics on almost everything we're following, and almost every index we're following, we're in this higher little pattern of higher highs, higher lows. So let's look. Another big important thing is the job number. The important thing about looking at this report on Yahoo Finance, the job number, the jobs, the unemployment rate, and how robust the labor force is, that has a big effect on the calculation of recessions. And we might, that because of the strong employment and labor force, we might not officially have a recession. But the important thing is, for a bear market, is there's a pattern where 3 months after, if there is a declared recession, stock market recovers. So, if you're timing things, and we're looking at let's look at our meeting notes. Okay, this is August right here. We're expecting, to be down, because we're overbought right now. We're expecting to be down for the next week or so. And August and September are two of the worst months performance-wise. We only have the end of September, end of quarter window dressing to really look forward to, because most of the companies reported already. There's not a whole lot of catalysts for the stock market to go up. And we have volume that's down. for the summer months because people go on vacation. But right now there's a certain amount of breadth of recovery. A lot of stocks in different industries are going up. And we mentioned last week that Apple was one of the first stocks to go over its 200-day moving average. So it's actually currently trading over its 200-day moving average. And as other stocks, start to go above their 200-day moving average, that is what's called breadth. And once you have a certain amount of stocks that are recovering and in higher highs, that's whenever you have a change from a bear market to a bull market. So let's look at our notes here. Okay, so we have S&P is up about 2% since the last meeting. We had some more indications that inflation is cooling off. You can see in the gas prices, they're going down. A lot of commodities are going down in price. And employment situation is really good. So we have a seemingly strong economy. That might mean that the Fed raises rates. Another important thing, let's look at the 10-year. Okay, so the 10-year Treasury is up a lot today. That's bad for stocks in general. And that was because of the strong labor report. And I put a little chart in our notes for today about how the relation of this Treasury to the price of stocks. And it's like an inverse correlation. So we're rooting for the U.S. Treasury to go down, because whenever the U.S. Treasury is down, that's usually when the stocks can appreciate more. All right, so let me see. Catalyst for markets to go up. Things that happened this week. Let me see. Tesla approved a split, so Tesla's going to be splitting pretty soon. The 10-year Treasury until today was down. It was down like 1.2%. So that was helping until we had this labor report. The other thing is we're still expecting the Fed to only raise one more time, and they'll probably signal that they're not going to be raising anymore. They might have, due to the strong labor report today, they might have to raise more. I don't know, but for me, I'm just trying to time my next purchase, and right now it's almost 3 months to 5 months till we're out of this. So that's a very good. A lot of smart people are saying 3 to 5 months from whenever they mention it's a recession to when stocks recover. So you see catalysts for stock in the market to go down. We did have a possibility of U.S. being pulled into a war. China tensions. Nancy Pelosi visited Taiwan, and China started reacting negatively with some warning shots and a couple other things. I don't know what's going on there, but we talked a couple months ago about the possibility of China invading Taiwan, and that would be a big mess because the United States counts on a lot of its manufacturing and products to do for inputs into their products. So China is very important to the United States, and if we get into a fight with China, that could affect a lot of companies. And that could, this could really pull the stock market down if we get into some kind of conflict with China. We mentioned, last week we were mentioning how things are switching a little bit from being more conservative, investors in general until the first half of the year, investors were putting money into safe things like drug stocks and low PE stocks, and now it seems like people are moving out of those conservative stocks into risk on or more high growth stocks. Let me see. So let's look at the variables in the stock market. The price of oil is going down. I'm not sure. We actually had OPEC increase production. So you increase supply, that means the price goes down if there's more supply and less demand. And in a recession, oil goes down because there's less economic activity. So that's oil going down is good for the stock market and for the stocks we're watching because it's an input cost for everything that's made in America, and that gives consumers more money to spend if they don't spend it all in the gas. And let me see, low demand. Okay, and 10-year Treasury until today, it's basically up just a little bit from last week. I wrote this earlier yesterday. So it's like this has no effect since last week. Let's look at the sector ETFs because we like to do that every now and then. The price of oil went up again, so the oil stocks are doing good, I know. Let's look at what else is happening. Change. Gold miners are doing bad. The ones that are doing good are the oil stocks. It's just a 1-to-1 correlation. If oil price of oil goes up, all the oil stocks go up with it. You see financial stocks. You see, so the financial stocks are doing good because of our inverse correlation to this. You see, okay, 10-year Treasury, it's going up, so that's good for banks and bad for growth stocks. So that's why we expected the financial stocks to do better. Let's look at what else is doing. Healthcare is going down. Okay, tech is going down too. So we could blame a lot of this on that 10-year Treasury and the jobs report. Because if the Fed is forced to raise more rates, that'll slow the economy down, and that'll make it more expensive for the for the tech companies to grow. Okay, let's look at our meeting notes. Okay, Fear Greed Index. We're at neutral now. We were noticing from last week the VIX was at 21, and that's kind of a complacency. That this VIX is like a measure of how much protection people are buying, how scared they are. And it's kind of a complacent level right now. So investors are getting used to, the stock market is obviously going up, and like 10 or 20% for most stocks in the last month or so. So now it's neutral. So we're getting to a point where if we end up getting greedy and extreme greed, we got to really temper our expectations, because that's whenever we want to either sell or not buy. So that, okay, so that kind of matches our VIX. It hasn't changed in a week. The VIX is at 21. So we're getting to the point where the people in the stock market, there are some major companies that are, such as Morgan Stanley, they're saying there's outflows now, and people are starting to leave the market. So it's a very good indication. Let's say people are complacent and the stock market's going up. So until further notice, we're going to be hitting these higher highs, higher lows. If we have a bad piece of news, watch this level on 617. We had 617, we hit a low. If we drop it down again, we'll go down to that low, and that'll be a retracement, and then we'll probably be better towards the end of the year for seasonality purposes. All right, so we're doing all this market timing just so we can time purchases when we draw our cost into the market. And in other words, when everyone's buying and the stock market's overbought, that's not a good time to put new positions in. That's the time you want to either reduce or sell some of the things that you want to get rid of, or just don't do anything and just watch it. All right, so right now the stochastics remain at a super high level. These levels here are the times you don't want to necessarily establish new positions. These are the ones you want to buy at the bottom of the range. Let me see. Okay, so we're going into the 2 worst months of the year. Let's go back down to the. There it is. The average. Okay, so we're out of July, which is one of the best months of the year. We're going into August and September, which are traditionally the worst months of the year. And sometimes people are afraid of October because of all the crashes that have happened in October. So 3 months, we have a little people on the edge. So don't expect a whole lot. We don't have any earnings reports. And in the middle of August and through September, and that's going to end. The people are on vacation. So there's not a whole lot going on, not a lot of news that could help us. So let's go back to, okay, we're going to, okay, so we noticed Alphabet was one of the first to break out of this this downward bear market, lower highs, lower lows, and it's establishing a new higher highs, higher lows. We know in their earnings report that they predicted 13% revenue growth for the next year. So that matches our expectations of 13%. So we think Google's grown at 13%. It's trading at the top of its range right now, so we have to wait for it to go back down to here to buy it. It's overbought. But this is one of the it used to be a leader, like Apple. All the big tech stocks were leaders last year, and it very well could be that they'll be leaders out of this bear market. So we think around September or October, towards the end of the year, whenever that 3-month timeline is from now. So that's August, September, November, and December will be 3 months from the bottom of, let's say, June 17th. So that will be a good time for us to bookmark as the time when the stock market recovers. 3 months from the end of a recession is when stocks typically recover. So let's look at another tech stock. It's Apple. Notice it's above its 200-day moving average, and it's the first stock to actually establish an uptrend out of this bear market. So that's making higher highs and higher lows. And you can see the next stop is lower from here if we're following the zigzag pattern. And it's been overbought for like a month and a half. So you see, here's an article from Jim Cramer. He says why he's losing confidence in Facebook parent Meta platforms. He actually met Zuckerberg. He was doing some metaverse things with him. He's a believer in the system, but there's a major problem. He thinks people are not spending as much time on Facebook, and they're spending their time on TikTok. And it's going to be really hard to recover from that. And it's going to be many years. He says Reels is not good enough. That's a competitor to TikTok. And he says they're not going to make that transition fast enough, and he thinks it's going to be a couple years of very slow growth before this can even catch on. So he's putting a warning flag out. We've already had a couple warning flags where they don't have total control over their platform. They're reliant on Apple's App Store, and they're changing rules on them. So it's becoming less and less secure of a sure thing for 13% growth. Although we're looking at it, and it's still showing 13% growth for the next couple of years. So we're following it. It seems like it's a fairly valued company. This is not taking into account if they lose more eyes and followers going forward. They're starting to not grow. And next, if they show they're losing customers and to TikTok. That's going to be whenever these numbers get modified. So right now it's fairly valued at 1 PEG ratio. And my summary here is it's not compelling. We have stocks that are have robust. They don't have competition. They have multiple earning streams, and it seems like Meta right now only has one source of income, that's ads for Facebook and its properties. So it's so the reliability, the earnings, you can see the red where they missed their earnings. It's not as good as some of the other stocks we're following. So we like to look at both sides of the situation, not just the good ones. So whenever things change, we got to be able to either invest less in it or exit the position. So we'll keep our eyes on these numbers. CFRA stopped giving fair value calculations on this stock, so that's not good. We really relied on that. And Morningstar says it's half off. So it's trading at half of a fair value of 346. So they have a very good opinion of it. Bank of America says they're only growing at 7% now. So we have a lot of conflicting numbers. It's not, we like to triple check and have 5 different ways to see, if they're growing, and if they all match, that's when we have a little more confidence. Right now we have different stories from a lot of different people, and we don't have coverage from CFRA, so it's become a little more dicey. All right, so Facebook and statistics. Yahoo Finance says its PE ratio is 16, and its PEG ratio is 2. That means Yahoo Finance thinks it's growing at 8. PE earnings growth at 8. And these numbers are good, but I just bring this up because we check in on stocks every now and then. Here's another article about Tesla. Its stock is far overvalued and could plunge more than 50%. So sometimes you read these articles, and sometimes they're made by not even professional people. They're made by someone in their basement, and especially on Seeking Alpha, there's a lot of. But you read this, you got to do the research and make sure it makes sense. He says the 4P is 76 times. There's going to be an economic slowdown, and they have a lot of competition. So they're adding a new. They're actually raising their prices in the cars. So there's a lot of different reasons why he thinks that they're overvalued and they're going to go down. We're going to look at the numbers of Tesla just for fun. We can see that the PE, it matches. It's 78. And the PEG ratio is 2. That means Yahoo Finance thinks they're growing at 35%. And these match. These are decent numbers here. This profit margin and return on equity are fine. Now, when we look at the annual earnings estimates, we see they're growing at 27%, 17%, and then that's decelerating growth. So they're in 2 years, if this is true, they're only going to be growing at 3%. Another thing this guy brought up in the article is the law of large numbers. That becomes harder to grow when you become a bigger company. So you can see that next year it's only going to be growing at 17% and then at 3%. So now PE is 73, and next year it'll be 4 times overvalued. Then the next year after that, it'll be 78 divided by 3, which is something like 25 times overvalued. And so that's, you see. So anyway, the point of doing this calculation here is it's kind of dangerous to put money in Tesla right now, because if they don't start earning more money and these numbers change, if they make one mistake, then they'll go to a PE-PEG ratio of 1, and that's whatever they're growing at. So it'll be a PE of 27, a PE of 17, or a PE of 3. Most car makers now have a PE of 5 to 7, like GM and Ford. So if they end up being a PE of 7, that's 10 times less than what it's trading at now. So we just have to keep our eyes on these annual earnings estimates just to make sure the numbers increase or decrease with our expectations. Right now, it's an example of a stock that didn't fall with the rest of the high-flying stocks. It didn't have a whole lot of earnings, and this is an overpriced stock.
I think it will stabilize once. I think once they do this final split. I think that's when they will kind of start stabilizing. They're going to do 3-1. But I think, same thing I kept. See, this is the thing. Chances of it going really low and crashing is low because compared to any other car companies, it's doing a phenomenal job. Tesla is definitely doing a phenomenal job selling cars. Even in the market when chips shortage and the supply chain issue, they still delivered pretty good numbers. And their earnings from I've been looking at last 6 to 8 quarters, they have been always positive. So I think you're right. They will eventually become they will stabilize. They won't go as fast as it could. But then in that case, the stock will also stabilize. It won't go so high or low pretty quickly. And I think it still has room to grow because there are a lot of things that Elon Musk is working on in the background. So but you're right. But in this market, I'll tell you this: I lost money on all the stocks in last 6 or 8 months. That when market crashed, 50% of the money, 60 or 70% of the Tesla is the only one that has saved money for me. That has been holding its value, holding its ground. Maybe it may have gone 20% down, but not more than that. 54%. It was pretty solid because if it was really kind of a stock which is just went up because of everybody was buying and FOMO, then it would have gone down like any other stock. Like you see Shopify, you see any stocks, everything has gone down, except I think the things that were pretty stable and went only 20-30% down was Google, Microsoft, Apple, all this. Even Facebook went down more than close to 50%.
50%, right?
Yeah. So compared to that, if you see, I won't lie, I made money on Tesla, options only this year, nothing else, and it has kind of, the rest all crashed. Doesn't matter. All the FANG stock, there is no more FANG anymore.
Yeah, right.
So, but Microsoft, Google, Apple, they're pretty solid stocks. They did not. Even Amazon is pretty solid. Those four were. Because we have it in portfolio, so you can see that they did not go more than 20-30%. Yes, Tesla, you're right. Eventually, it will the growth rate will reduce and it will drop to that number. But it is way far ahead in the race compared to any other company.
Right. So they really have to innovate or change their business model or maybe buy Ford so they can add production. I don't know what they'll do, but it's right now there's something we're using right here. This is like consensus estimates. We don't know all the people that this E-Trade is pulling into this. I know Refinitiv has its own consensus estimates, and Bloomberg has their consensus, and they're a little bit different. So we have to take this with a grain of salt. I don't know. There's really no indication where they're getting this from, but if we have to just make sure that you don't have any oversized. Whenever something's dangerously priced, like it's overvalued like this, you can't be overweight. This in your portfolio. You have to scale back a little bit, and if you have too much of it, because one bad mistake, or maybe just with the law of averages, they'll become a GM and a Ford, and then they'll be growing at 3 to 5% like the other car makers. But you have to this is something like we were following the stock. What is it? We were following Upstart, and we were saying right around this time, the stock's overvalued. If you own it, it's time to take a little bit of profits, and if it goes up, you'll buy it. You're at seller's remorse, but at least you book some of the gains, right? And then you put it into something else that was more diversified. So that's kind of the same idea that as stocks do well and their projections are starting to go down, it might be a time to reduce the exposure to that and get into something a little bit more diversified. So that was just a good exercise we could do. Now, next thing is I saw an article on eBay. Luxury focus drives earnings beat as consumer spending slows. Mark mentioned how some of the luxury handbag makers, and I think he was following Tiffany, whoever bought out Tiffany, and a lot of the higher end luxury companies are doing really good in this environment, and eBay is starting to focus on that. And in this environment with inflation, some of the higher end customers, they don't have the problems that lower pricing point customers do. So they had a decent earnings report. So I thought I'd look into this because we haven't checked into eBay in a while. So I looked at the earnings estimates from E-Trade. Oh, I guess it didn't print out on my printout, but it says basically they're growing at 9, and 13% for the next 3 years. So that's around 9%. You can see that their stock is down, and pretty much sold maybe due to a recessionary. If people are in a recession and they're spending on gas, they're not going to spend a whole lot on discretionary goods, things from eBay. Or maybe they will spend more because they can't afford the new things and they'll buy used. I don't know. Just for fun, I'm looking at the numbers. And I noticed the PE ratio is 12. So and its PEG ratio is 2. So Yahoo Finance thinks it's growing at around 6%. And so the profit margins isn't that great. And return on equity now is negative 27. So we have a lot of conflicting numbers. We have missing numbers and the earnings projections, and it's pretty inconsistent. So right now this is more of an inconsistent stock, and so it's about fairly valued at a PEG ratio of 1 based on our calculations. But we're dealing right now with a fickle customer that possibly during a recession they might not buy as many things. And a lot of these numbers are negative, and so let me see there. I tried, we looked at the CFRA's numbers, and they think it's worth $169. I said, what? How in the world did you get that? So they still think it's worth $169. And they said they have a unique position in secondhand goods. And they said it might be a difficult economic time during this year and next half of next year, because of discretionary consumer spending. If they don't, this is things that people don't need, and they buy because they have some extra money. And it might do better because the gas prices are going down. But you see, Morningstar thinks that they're worth $65, so they're 30%, 20% off. So both CFRA and Morningstar think they're on sale right now. And we see consumer pressure should bleed into 2023. Okay, so they think they look cheap. So we're going to keep our eyes on that until these numbers. When we look at the numbers, we expected this is only 9% growth. So it's not that compelling. If they're growing at 9% and the forward PE is 12, compared to some more reliable stocks, and we have some negative numbers here, this is like we'll keep our eyes on it. And Bank of America says they're only growing at 5%. So all in all, if they're growing at 5%, that's kind of out of range. We want at least a 10% growing company for a growth stock. So we'll keep our eyes on this. But right now, there's a lot of things missing. Okay, here's another article. The U.S. declares monkeypox emergency, weighs step that could quintuple inoculations. And we mentioned, I think 3 months ago, I remember we said, oh, monkeypox person found in America. And I said, well, maybe this could be the next big pandemic, and at that time, we should have done this exercise here. And, what stocks would benefit and which ones would get hurt if this ends up being like COVID. And can anyone figure out what could be and what could not be stocks that would benefit and would fail because of this emergency?
Well, clearly your Pfizers and your ones that come up with vaccinations, as well as your travel companies could be in danger.
Right.
Car rental could be in danger.
Mm-hmm. And which ones could do good?
Let's see. I don't know. I'm thinking along the lines of the same that we're doing well in COVID pandemic. So but that's retail sales. Amazon's, your eBay you just spoke about.
Right.
You could get in it. I was about to say maybe some of these tech stocks, but I don't know. Those are quite overbought during the pandemic, and maybe everybody already has all the work from home computer equipment you need. I don't know. Anybody else?
Okay, I'm going to go to the answer. Okay, so the answer is, well, you got most of them here. Drug stocks is one thing that are positively affected by pandemic. So basically, they call this a pandemic playbook now. Whenever there's an indication that there's something bad, you have two sides go up and down, or based on whether it's good or bad for the pandemic. Drug stocks like Moderna, they'd have to come out with some kind of version of a vaccine for the new virus. Pfizer, you said, Gilead, Bristol Myers, Walgreens. Walgreens and CVS will do good because they got to give the shots and the inoculations of the serum. And you see Amazon, like you said, and eBay will do good because people are working from home. And then ones that are negatively affected, you mentioned them, the airlines, cruise lines, gambling stocks, and especially retailers. I said specialty because, like American Eagle, if they close the malls down, but they might not close Walmart. So not all retailers would. Actually, Walmart did much better during that time. And so the one thing that to mention from the pandemic is the tech stocks, the big tech stocks outperformed the rest of the market because they had the resources to pivot and to change. And Microsoft had offerings for work from home, and then you had let's say people spent more time at home to, on their Facebook, whatever. So, the I guess the lesson learned from the pandemic is the big companies are resilient and they can find a way to work and reinvent themselves to flourish or not be as bad as other stocks in bad environments. So I think that, like you said, tech stocks, there's something called carry forward purchases. Like people already bought all the toilet paper they needed last March. They're not going to buy any more in July, right? So they buy it, and they're not going to buy that again. So they bought some Zoom subscriptions, and you're not going to repurchase that again, or maybe Teams. You're not going to buy another version of Teams. You're already subscribed. So, so you have to, like, almost any major news story that comes out, like Taiwan visit from Nancy Pelosi this week, you got to look at it as a binary outcome. You got to come out with your list of positively affected, negatively affected, and monitor that story and see if it really affects any of the stocks you follow. So will there be another lockdown? Most likely no, because I think people know now that you got to wear masks and they're trained, and it won't be as maybe as infectious as before. I don't know. I think a big problem in America was we didn't have masks at the beginning of the pandemic, and I guess a lot of that spread because we weren't trained and we didn't have that in the stores to buy. So we'll keep our eyes on that. It may or may not turn into a pandemic, but they said stuff that could contribute. Yeah, so Moderna actually went up 15% one day this week. This is one of Mark's favorite stocks. And Moderna, they make vaccines, and they have a very low PE ratio, but the one problem with Moderna is their unpredictability. When I looked at the earnings projection of Moderna, here it is right here, you can see that they're all over the place. 2022, $26 a share. I'm looking at this right here. Next year, $8 a share. After that, $5.58 a share, $6.18. So it's not very predictable, and that's why I can't invest in it, because if the analysts can't project, this is all basically dependent on what drugs they come up with to sell. They say they have a good pipeline. Mark, do you have any good insight on this company? Okay, that's enough. All right, so I'm not sure, but why it went up a lot? Maybe because of this pandemic scare, possible monkeypox issue. But all right, so almost any article that comes out in the news, you gotta say, does this affect the stocks that I own or not? And there was one news story that came out today that in the news, okay, buybacks. Okay, there's an article that said they're going to tax the buybacks 1%. So the new bill is, if they tax the buybacks 1%, that affects almost every tech stock that we're following, because when it's part of the return to shareholders for companies is buying stocks back, then you get a better earnings, because price to earning is calculated with the amount of outstanding shares. So let's look at one more thing. Okay, I mentioned this already. China is already starting to make a big deal about this visit from Nancy Pelosi to Taiwan. we were talking half a year ago, about possibility of China invading Taiwan and what the ramifications of that is. And most of the stocks we're following rely on chips manufactured in Taiwan. So if we don't get our chip manufacturing made locally in America pretty soon, then we might have a problem making things for almost every industry we have. So we're going to keep our eye on this article. Hopefully it doesn't explode into something big. Okay, so this is a good story about how we've been saying for like a year or more about how the 10-year yield is like a very good indication of whether stocks are going up or down. And this is an article that basically says that the bond market drives, the stock prices. And you can see in this little graph that as bond prices, which are purple, go down, the stock market goes up. So we have an inverse correlation theory that seems to be working out. That's why we keep an eye on the 10-year Treasury. And the 10-year Treasury jumped today on the job market, and as soon as that happened, the stock market went down. So this 10-year Treasury yield is, like we were saying for a while, good for growth stocks when it goes up, and when it goes down, and bad for banks when it goes up. So that was a good lesson learned. Okay, here's another question. Anyone who might know this. Warren Buffett says, what is the biggest mistake people make with their money? And anyone here know of a big mistake people make with their money?
I just going to guess, save the money in a bank.
Close. Okay, so the biggest mistake that people make is saving properly. That's right. Not learning the habit. It's a habit of saving properly. Yes. And he said the biggest mistake is not learning the habit of saving properly. He said most behavior is habitual, and that, they say, is the chain of habit is too light to be felt until they are too heavy to be broken. So, in other words, and what are ways that you can do to force yourself into a habit? Because people are, I'd say 90% of the U.S. population, they grew up, and the way they do things is they spend what they have and they live paycheck to paycheck. That is the majority of the population. And what Warren Buffett says is you invest first, whatever's left over, you spend. And so a way to force yourself to do that is to make it automatic. In other words, let's say you have a paycheck of $800 a week. That's just for hypothetical. And so that $800, you want to invest 10%. So you can do this with brokerages, automatically take out 10%, like maybe $100, and put that into your brokerage account and invest it in your favorite stocks, or maybe S&P 500. Okay, so that's one way to do it. And here's another thing that Warren Buffett says. He says whether we're talking about stocks, he likes buying quality merchandise when it's marked down. And most investors do it differently. Most investors don't like buying stocks when they go down, because it might go down further. It's like and Warren Buffett says whenever it's raining stocks, you want to bring a bucket out and not a thimble. So he said price is what you pay, value is what you get. So you want to make sure you buy a stock and that matches its value. That's like we were talking about Tesla today. Tesla is trading higher than its true value is. So you have to wait for it to go on sale, really, to invest in that. And Buffett says you have to, you can save by buying discounted items. So saving properly. So whenever I grew up, I saved everything, every penny, and I counted my piggy bank every week, every day. I counted it. And so I was trained, to always, save. So that's, but some people don't do that. But you got to force yourself and say, I'm going to invest a certain portion of your paycheck. And once you have that habit, then and you have this mentality where you just don't look at how much you lose. You look at what it's going to be worth in the future instead. That's like what they say in hockey. You don't look where the puck has been. You look at where it's going. So
yeah, I struggle with that. I understand both sides of it. I wanted to add, so something else I'll do is, like you say, well, some people fear buying when it's going down because it's going to keep going down. I might see it bounce and it start going up, and I'm like, it could go back down. I want to hold up, and it seems like that whole thing just trying to time it, and I end up losing.
Yeah. Well, let me see. There was a guy that ran a Magellan fund. I think Peter. No, his name's Peter. He said it's not timing the market; it's time in the market.
In the market.
Yes. So what we do,
you refer to Peter Lynch?
Peter Lynch, yeah. Yeah. So it's time in the market, not timing the market, and so we like to. It's pretty dangerous to try to get in and out of the stock market. What we like to do, what I like to do. Okay, so I like to use this overbought and oversold the time when you're going to buy in the market. Like right now we're overbought.
Right.